This video is going to be a long form video review of this book, Right Track, Your Retirement, written by Brian Quaranta. He's a Pittsburgh guy, for anyone watching, back in Pittsburgh. A lot of great stuff in here, and I have a lot to cover, so I'm just going to get right into it. This might be relatively long, like I said, and then in the post, I'm going to have a link to the article as well, if you want to just read the article. So the first thing, the way I approach this is the first part I'm going to go through is just the spark notes, basically. I'm just pulling out some of the key information and I'm just reiterating that to you. The second thing, so there are a couple fundamental principles where I slightly disagree with the author. So I'm just going to go through those three principles. The reason for that is because I'm going to use that as the lens for the third section, which is my analysis. So it's kind of taking the raw information, looked at through the lens of my principles to give kind of my analysis on the content. And then the last thing, just some quick recommendations, some just action items. Hey, this is what I think you should do right now. So let's get into the first part. The first part is just going to be some information from the book, and I'm going to be reading off my notes. So I'm not going to really be looking at the camera. I hope you just focus on kind of what I'm saying. So the first one is kind of why this is important. Okay, so and a lot of these are just data points. But so from the 2019 World Economic Forum, the average 65-year-old could outlive retirement within 9 years. The other thing to be cognizant of when you look at the data is the biggest beneficiaries of your retirement account can be either Wall Street, which with basically fees for a lot of these assets, or Uncle Sam in taxes. And again, these are kind of just things in the book I'm reiterating. It also called out, so this used to be easy for like my grandparents when CDs were 15% and inflation was low, but it's now for boomers much harder, and then for my generation and beyond, it's going to be much harder. So this is something everyone needs to be looking into. 2 out of every 3 men underestimate how long a man will live in retirement, and 1/3 of women do the same. So a lot of people don't plan appropriately. The next part is the author had a couple frameworks. So these are just things to think about. So he gives 6 principles. So things you need to consider for retirement: your income during your retirement, your investments, where they are, your efficiency, your taxation, your tax plan, healthcare, and then legacy planning. You know, how do you leave things to those that you're leaving behind? The next thing I like a lot, he talks about kind of 2 parts to investing. You want your investing plan and your retirement plan. So what that means is, for like me right now, up until probably your late 50s, that you should be focusing on investing. So all that matters is making as much money as possible, right? That's your growth phase. And he sort of recommends actively managed mutual funds. I'll get into my take on that kind of towards the end. Then the next phase is the retirement phase. So you want to diversify into assets that are going to have less exposure to market volatility, and then are going to provide consistent cash flow. So kind of 2 phases to how you want to think about retirement. The next thing he talks about, so if you have a wealth manager or retirement planner, I recommend you do this. But when he works with his clients, he runs 3 scenarios. So the first one is, what is your retirement plan with a spend down rate? Meaning, what is your plan if we take your retirement principal all the way to 0? That's the first scenario. The second one is the preservation rate. So it's, what is your plan if we maintain the principal in your retirement and basically just live off the growth or the interest? The third one is the legacy rate. The legacy rate is if you don't need an income for some reason and you only want to take the minimum distributions required to avoid taxes and penalties. So I think that's a great idea to talk to your advisor about that. He talks about 3 different places to put money. So you can put it in banks, where you can get CDs or savings accounts. You get liquidity. The downside is low interest rates. There's the stock market, stocks and bonds. So higher yields for you, but the downside is basically if there's a downturn, when you need to retire, that's going to be challenging for you. So more risk with the stock market. And then the third one are insurance companies. So that's guaranteed income, but at a high price. They're costly as far as what you get back relative to what you give. He says there are 3 risks to be aware of: taxes, long-term care, and inflation. He says the function of a retirement plan are the following. provide an income that can account for variable time and life events. And your goal is to get an income as high as you can, as safely as you can, and tax-free as you can. The second function is provide written proof of your plan. So basically a 1, 5, and 10-year retirement plan. Third, have a tax strategy or a tax plan. Fourth, organize everything in one place. So have a single advisor. And then fifth, instruct your heirs on how to carry out your legacy. So if you're thinking about retirement, that's probably good advice to make sure you're thinking about all 5 of those things. So now here's what I consider kind of some key takeaways. So he had a really interesting hypothetical scenario where he made up names Jack and Jill. They both had $1 million during retirement. Jack retired in 1996. Jill retired in 1999. But if you play out, and they both followed what this old adage of the 4% rule. So there's kind of this old rule that said when you retire, take 4% of your distributions and you'll be safe. So he played out this scenario. What happens is after 23 years, Jack still has $2 million, so doubled his principal. Jill was about to run out. She was down to 140,000. And what happened is because in 1999, the market went down for a couple of years. So what happens there is for those years, you lose principal while you're taking distributions and your portfolio never recovers. So he calls this sequential risk, where if when you retire, the market starts going down, that's a big problem. So that was a really powerful kind of story to be aware of. And kind of what he points out, which we'll get into, is to avoid that, you want 2 buckets. You want your growth bucket in the stock market, and you have another bucket in annuities, which we'll talk about. The second thing he points out, which I love, which I agree with, is when you hire active money managers, they aren't actively trading on your behalf. So you might think, you got this guy who's super smart, where if the stock market is starting to go down, they're going to get in there and they're going to trade and reposition and make sure you're covered, but that doesn't actually happen. There's 2 reasons for that. One, they're legally not allowed based on an SEC regulation. And the second one is markets move so fast that these money managers can't possibly cover all of their clients' bases in the time they need to. And I agree with this. And he later goes on to say that 70% of the market is traded by algorithms, which I also agree with. So this is tied to the point I say a lot is if you're going to be in the stock market, be in index funds, don't have an active manager. He talks about 2 different types of agents, which I've talked about before. The way he defines them are captive agents and independent agents. So captive agents are with name brand institutions. If you're working with Fidelity or Baird or any of these big names, things to be aware of is that these captive agents are limited in the offerings they can provide you, meaning they can't sell you certain things. One of those reasons is because they're not legally allowed, but the other one is kind of the pessimistic viewpoint is they're probably only going to recommend things to you where they're going to make a commission, right? And again, that's pessimistic, but it unfortunately is true. It happens quite a bit. So the challenge there is if you're with one of these captive agents, is they're probably not going to recommend you annuities, which is kind of the author's thing. He likes annuities. My thing is they're definitely not going to recommend you private real estate deals. So that's kind of my specialty. So that's why I kind of talk about this a lot too, where if you're working with your captive agent advisors, that's great. But you also need to be talking to someone like me who can give you some insight on kind of like private real estate deals and things like that, or the author who can refer you to some annuities and things like that. So the second type of agent is called an independent agent. So that's what the author is. He's kind of an independent wealth manager. So the difference there is they're going to have a wider array of offerings, right? They're going to be able to refer you to a mutual fund, to insurance, to a tax advisor, a legal advisor, etc. That's sort of what I do too, except where I strictly focus on private real estate deals. That's my really small niche there. There are some, there are some things to watch out though for with captive agents. this is kind of my take, it's not from the author, is one, they usually just charge fees for their time. So their performance isn't usually tied, or sorry, their compensation isn't usually tied to performance. So watch out for that. The second one I talk about a lot is I call these incestual referral networks, where from my observations across all spaces. So these are wealth managers, these are other private deal vendors like I do, these are contractors. I call them incestual referral networks because you have to watch out for people who aren't qualifying who they're referring you to. You know, they meet someone at a cocktail hour and now they're friends and they refer each other clients back and forth, but they're not actually validating that you're getting a top tier service. You know, you kind of just get these little networks of referrals and everyone's happy to get a fee and drink beers together and things like that. So just watch out for that. Make sure anyone you're getting referred to, you compare that person to some other sources, Yelp or Google or something like that. And then the third thing, the only thing I don't love about these captive agent companies is if you try to be great at everything, you're probably not going to be great at anything. Meaning it's like they can probably advise you across the whole spectrum of what you need to know, but I'm not going to believe that they're going to be the best at every single one of those things. The alternate option would be to you go get independent advisors for all of the different things that you need. Okay, so now just a couple quick things still from the author that were in the book. So I mentioned the old adage where kind of you're supposed to take a 4% distribution for your retirement. The challenge there, though, is that was based on data from the early 90s. So in current day, the failure rate for that rule is 57%. That was a statistic from the author, but it's an important factor, you know, meaning that the market's a lot more volatile in current day. The other thing, okay, so I kind of talked about this with the sequential risk, but if you take a 50% loss and then you make a 50% gain, you still have not made your money back. Okay, where mathematically it is much worse to lose money than have less gains and not lose. Okay, and if you just think about it, you know, if you have $100 and you take a 50% loss, you now have $50. If you make a 50% gain, you only have $75, right? So you need to basically earn twice as much in percentage points to make your money back. So the author's point is you really need to be cognizant of not taking losses. Because that's what a lot of people say too. That's what like Warren Buffett says, and a lot of the big investors. The key is not to lose. It's not to make as much as possible. It's to not lose. He goes through some of the types of annuities. I'm just going to go through this real quick. The first one are variable annuities. These are basically tax deferred with active portfolio managers. If you're interested, just look into it more. The author doesn't recommend it, so I'm not going to talk about it. The second one is an immediate annuity where you can get cash immediately. The challenge here is that they keep your money forever. So it's really high fees. You know, based on the money you put in, you're not getting much cash flow on that principal. And then the third one is what he recommends. These are indexed annuities. So how this works is you pay money, let's say for 10 years into an annuity. That money, you pay money and then you can't touch it for 10 years. This indexed annuity, they're going to put that principal in some sort of index fund. So like I've talked about before and what the author says, that's a lot better than actively managed funds like the variable annuity. And then after 10 years, you'll receive payments. And the kind of key point here is that, like, let's say over the course of that 10 years, your principal goes up 30%. You're only going to get some portion of that, let's say 60% of that growth, and the insurance company takes the rest. But so this indexed annuity is what the author recommends, and that's what he recommends for his retirement bucket. So he kind of talks about like, hey, for your retirement plan, have one bucket in the stock market, you know, that's going to have some volatility, but that should be money you don't need for 10, 15 years, and you let that grow. Because what happens is 10, 15 years is going to be enough time to mitigate any down cycle. The down cycles are usually 5 to 7 years. In your other bucket, he recommends this indexed annuity with guaranteed cash flow. So that's kind of like the main point. Okay, so that ends the section of kind of like the spark notes of the book, and I kind of just talked about his main thing, which is putting some amount of your retirement in that indexed annuity for guaranteed cash flow. So now I'm going to provide just 3 principles for how I'm going to analyze this book. So the first one is risk. He talks about annuities as zero risk. What the challenge with zero risk is an exponential increase in cost. So what I mean by that is nothing in life is zero risk. So if you're going to retire, your chance of premature death is 12%, which is super high, right? For healthy retirees, let's just say that's even 1%. So an order of magnitude less of what it actually is. To go from 1% to 0% in anything is going to have a hockey stick exponential curve in cost. So the reason I say that is with annuities, right? You get a guarantee with an annuity, regardless of what happens with the market. Well, guess what? You are paying for that, okay? As opposed to if you are willing to accept a very, very, very small amount of risk in private markets, an example would be, let's say, a fund that invests in promissory notes, and you're in first position promissory notes. I'm invested in a fund where over the course of the last decade, there have been thousands of notes with a 0% default risk. Okay, super, super, super low risk, but it's not zero, right? It's more than zero because it's possible, but I can make 8% cash flow on my principal, as opposed to an annuity, which you are guaranteed there is no risk at all. That cash flow is going to be way, way, way less than 8%. I think it's something like 1% when I looked at it last. So that's the first principle is risk. From my perspective, if you want something at zero risk, that's not realistic and you're going to pay for it. The second one is, for me, objectivism. So a lot of financial advisors will tailor the portfolio to the investor. The challenge with that for me is that there is a pragmatically correct option with most of this stuff. You can calculate the internal rate of return, the net present value. You can look at the sequence of cash flows. There's almost always an objectively best answer. So as an example, objectively, an annuity is probably not your best option in a lot of the scenarios. Okay, there are some where it might be, right? If you were just getting ready to retire, you need cash flow immediately, then okay, maybe an annuity is a good option. But objectively, it is rarely the best option. Now, although I am saying there's an objective answer to these, it is okay to make emotional decisions. But the reason I want to make this delineation is because most advisors are going to say, oh, this investor has a low risk tolerance, so I'm going to tailor this portfolio to them. What I would rather do, say, listen, I understand this is not the best option. This is the best option. But to account for the fact that you're experiencing some emotion, you don't feel comfortable with this, let's still do what you want to do from an emotional standpoint, but let's take one baby step to get from where you are here to where you could be. All right. And that's specifically in regards to exploring private investment opportunities. So yeah, the third thing is the third principle is just my knowledge of private markets. So I think the author has been exclusively in the institutional space in public assets. So given that he hasn't had the exposure that I've had with private real estate deals and a lot of success that I've had as a limited partner, that's why I think some of our opinions are going to deviate. But what I would submit is I think if the author and I were able to share our experience somehow, I think we'd probably reach a lot of the same conclusions, because pretty much everything else other than, the opportunities in the private space, we are aligned on. So now so that's the second part, the principles that I'm going to analyze this book. This third part is my analysis. So I couldn't agree more with the fallacies of institutional wealth management. He mentions that a lot, and I talk about that a lot. I share the author's philosophy on different portfolio strategies. So for me right now, I'm in the growth phase. I don't care if I have a 7-year hold period for certain deals. I just want to grow that. But as you get closer to retirement, you want to look at kind of consistent cash flow. So we're aligned there. The only difference is he's strictly considering institutional options, which aren't a lot. It's basically you're in a mutual fund or you're in an annuity. Whereas for me, in the private space, there are a lot of other options. There's different types of structures, real estate deals, investing in business, note investing. So there's a lot more options in the private space, but in principle, we agree on the two bucket strategy. The third thing, I already alluded to this, is I just disagree with this annuity option. I think it's something you should consider, but when you benchmark this against private investment opportunities that have non-zero risk, like I mentioned, but as I gave the example of a fund with a 0% default rate over the course of a decade with thousands of notes done, where that mathematically accounts for all of the historical volatility since the early 2000s as far as potential market corrections. That is very close to zero risk, very close. And you can get order of magnitude better deals. So if you want more info on that, in the white paper, I actually did a video. I did a video comparing like a sample private deal to what you might get from an annuity. Or if you want to know more about kind of some of the things I'm talking about, which would be investing in some sort of promissory note fund, yeah, you can just DM me. But I know quite a few people that do that for their retirement. It's a very low risk option where you can get about 8% cash flow on your principal, and your principal's protected. Okay, I talked about the three different scenarios that he will run with his clients. The rundown scenario, where your principal goes to zero in your retirement, the preservation rate, where you maintain your principal, and then the third one is the legacy rate, I think. If you incorporate private deals into your retirement, I don't think you should ever consider the first one, where your principal goes to zero. There's too much risk there, and it's not needed. Because if you incorporate private deals into your options, it's actually really easy to preserve your principal. I just gave you an example. Basically, a guaranteed 8% cash on cash on your principal. So that's going to be almost as good, if not higher, is your average growth fund in the S&P, except for there's no volatility and it's all cash flow. So that's just one example, and there are better examples as well. If you start looking into private deals a few years before your retirement, because what you can do is kind of diversify. You can diversify into multiple deals, and you can receive consistent cash flow basically every quarter. So if you get ahead of your retirement, you can get a lot higher than 8% cash on cash. And if you're interested in that, I've got a bunch of videos on my YouTube channel on examples, or you can just DM me and I can show you some examples. His next thing is active fund managers. So I say this a lot. I totally agree. If you're going to be in the stock market, be in index funds, not actively managed mutual funds. I provide this statistic a lot. I'll be publishing a white paper in about a week, but over the course of a decade, 91% of actively managed funds fail to beat just the S&P, right? Which meaning they're going to return you less. So they're charging you money to get you less money. It's crazy. So it's a really bad idea. He mentions that multiple times. And just anecdotally, a big reason for that, like the author says, is because it's really hard for them. It's really hard for these fund managers to respond for all their clients in the amount of time they would have to respond given how quickly the market reacts. So anecdotally, some of my friends who are on Wall Street, they get hired by these big, like, $100 million plus, basically family trusts or whatever. These trust funds or these family businesses want a dedicated, basically money manager only for them, because that allows them to respond with the velocity that they would have to respond to have any chance of beating the market. And still, a lot of them don't. But so for you, actively managed funds are probably not a good idea. The last thing, the author does kind of, I mentioned my inference is he's recommending actively managed funds if they're trading with an algorithm. He mentions this with a new technology, that an algorithm is a new technology. I humbly disagree with that. When you think about, first of all, an algorithm is just math. That's not really a technology. But when you take a look at these big banks, so the following technologies are what they would need. The first one is to get market information. So a lot of that is publicly available, but they also have to look at things like news articles, financial reports. So there is some new technology, the natural language models that are coming out. They can better just take raw information, index raw information from the internet, and basically translate that into a database. However, that's not new. I was working on that in 2010. We were building software that did that for the CIA. They'd go look at news articles, basically overseas for terrorist organizations, and it would automatically aggregate all of those articles and establish basically networks so that certain individuals could figure out how to best decouple the network. So that's not new. That's been around for over a decade. The second technology you would need is some sort of like predictive mathematics, where given all this information, you need to run all these different scenarios, to figure out the best places to put your money. That also has been around forever. Ray Dalio has been doing that for over a decade. All the big hedge funds, all the big banks are all already doing that. And then I was doing something similar to that at Westinghouse back in 2012. So the big challenge with the algorithms is they still require a massive amount of human input to function correctly. So my take, where I slightly disagree with the author, he seems to like this new algorithm trading. I still don't like that at all. I still put that in the bucket where 91% of actively managed funds fail. So I would not recommend that. I would still recommend an index fund. Okay. So the last thing are just two recommendations from me. One would be get the book if this information is interesting to you. I don't personally know the author, obviously. I've never talked to them, so I'm not incentivized to say that, but it's a lot of interesting information. The first one is I do like the independent advisor strategy better than the captive advisor strategy, like we talked about. So the author is an independent wealth manager. So I think that's probably your best first step if you're thinking about retirement, is talk to someone like, Brian's team, because they're going to give you kind of a holistic overview of your retirement. Or if you go directly to like a Fidelity or a Baird or someone, they're going to kind of be probably laser focused on just what their institution does. And they're not going to be able to give you all the options. So I think talking to someone like this is a great idea and kind of getting their take on things. The second one, for me, obviously, I like the private market, right? So everything in this book is still based in public assets. So like an annuity, like I've mentioned multiple times, it's going to give you guaranteed income. But guess what that insurance company is doing? They're still investing that in the public markets, right? And guess what? 9%, only 9% are doing better than the market. So this insurance company is probably not that 9%, right? That 9% are probably hedge funds that focus on that. So when you think about that, is you have to think about how can an insurance company afford to do that, right? How can they afford to guarantee a payment for you when they're accepting known market volatility and they're not making any more money than anyone else? Well, the answer for that is cost, right? They're going to guarantee you a payment, but it's going to be way, 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 way lower than something you could get in the private market, like I've mentioned a couple of times, if you were willing to accept an extremely small amount of risk. And I keep saying that, but when I say extremely small amount of risk, if you diversify in the private market, right? If instead of, let's say you put $500,000 into an annuity, instead of that, if you go, invest in multiple private market opportunities, that's effectively zero risk, right? It's only the only place where you assume a very small amount of risk is if you put all of your money into one private real estate deal, because the risk with private real estate, that's different from public assets really comes down to personnel. It's like, what if there's a major accident at the business? What if, this kind of like long tail risk, but there is risk that you don't see in the public markets, but you can mitigate that through diversification in the private market. So that's my main second recommendation is, a quick story with my mom is we're planning for her retirement is she's a super conservative investor. I watched the Dave Ramsey videos based on her recommendation, in high school. She's followed the Dave Ramsey plan her whole life. So the thought of doing something new, like investing in a private real estate deal right before she's getting ready to retire is kind of gut wrenching, right? It can be stressful. But so this comes back to the second principle I talked about, where objectively, mathematically, it is the best option, right? There's no tailoring the best option to the investor. It is the best option. However, we want to account for, the emotion of doing that. So the strategy we took with my mom, we took a small amount of money and we put that into a private deal. So if something crazy happens and she happens to lose that, she's going to be okay. But the 99.99999% thing that's going to happen is in 3 years, this is what this is going to look like. Is in 3 years, she's going to get all her money back, plus some additional principal with cash flow. And then we're going to put that in another private real estate deal. And guess what? She's going to retain an equity ownership in that industrial facility, which is going to continue to cash flow for her $6,000 or $7,000 every quarter. And she's gonna be like, oh, this is nice. So we're probably going to put that principal back into another private real estate deal that's going to do the same thing. So if you take a look at the numbers, in about 6 years, she will have 3x her money. These are 25% internal rate of return deals. 3x her money. We're going to take a look at that, where with 25K, we made, 50, 60K. So now she's got 75, 80 with that small thing that she did. And we're going to benchmark that against her other retirement account, which is right now actively managed. I just analyzed the last 6 years. They failed to even come close to the market for 6 years, right? They didn't make as much. Every year there was an up market and they lost more than the market in down markets. So we're going to take a look at this private deal against her actively managed fund. If it's anything like my numbers, it's probably going to be 3x. So doing 3 times better than this. And then she'll probably end up doing an annuity with some amount of money. So we're going to take a look at that, and I will normalize that relative to if there was an equivalent amount of capital in her private deals versus the annuity. We're probably going to see her cash flow with the private deals is about 10x, right? So because we took that baby step over time, she's going to actually see that come to realization. And if I had to guess, she's going to be like, well, I like this, right? I like the private real estate. So there's still plenty of time, for the next 20 years. Now we've been able to get through that barrier of doing something that's uncomfortable. She's still going to have 20 plus years to now make better decisions and incorporate those private deals more heavily in her portfolio. So anyways, that wraps up my review of the book. Again, right track to your retirement. We covered the Spark Notes. We covered the principles for analysis. We covered my analysis, and then we covered my 2 final recommendations. So I really hope this is helpful. I know it was long, but if anyone has questions, you want to chat through it, feel free to just reach out. Thanks for watching.